Welcome to Bitcoin Escape Plan. This is an advanced Bitcoin trading course. My goal with this video is to help update you on everything that I understand about my trading strategy as it stands at this moment. If you want updates on that, make sure you subscribe to this YouTube channel here and at bitcoinescapeplan.com to get future updates as well as up-to-date, no-nonsense analysis of what's going on with Bitcoin. This is not meant to be financial trading or investing advice, simply educational material. Investing and trading does involve significant risk and potential loss, and most traders will lose their money. My goal with this strategy is to help you lose less of your money by focusing on only one chart, the Bitcoin chart. So in this video, we'll go over what are perpetuals and futures contracts, how do we profit off of them with our knowledge of the Bitcoin chart, what are rules for the 4-hour break room. The 4-hour break room is my private membership community, currently only accessible by request. So send me an email over at bitcoinescapeplan.com or a DM on Threads, and we can talk about whether or not you are a good fit for that program. You can also book a one-on-one coaching session with me at the link in the description down below on Calendly. After that, once we have gone over the rules, we will go over the difference between the scalping part of the strategy and the trend exposure part of the strategy and how I'm changing my initial opinion on that over time. That's the difference between how I use the perpetuals and how I use the futures. And then at the very end of the video, you do not want to miss this. I don't care if you pause it and come back to it later. You do not want to miss the end of the video where we analyze how we actually can use these at the end of this cycle to maximize our profits on this Bitcoin cycle. This is what the president is going to be doing. This is what politicians and corporations are going to be doing. Very, very important. You do not want to miss the end of this video. So let's get started. What are perpetuals and futures contracts? Well, let's ask Google. So perpetual futures are cryptocurrency derivative contracts that allow traders to speculate on asset prices without an expiration date, meaning positions can be held indefinitely. Actually, it's about 5 years, but whatever, Google. They utilize a funding rate mechanism where payments are periodically exchanged between long and short positions holders to keep the contract price anchored to the underlying asset's spot price. Essentially, whatever the price of Bitcoin is, that's what the price of the perpetual future is, divided by, like I use the Coinbase ones, for example, those are Nano BTC. So I think that's like a 1/100th of the actual price, very similar to how an option contract functions. Traditional futures are standardized contracts with a fixed expiration date. That's the end of the month for the Bitcoin one, where the underlying asset is either physically delivered or cash settled at maturity. They just give you cash for it. Unlike perps, traditional futures do not use funding rates. Instead, their prices converge to the spot price only at expiration. Just means you pay different fees. These contracts dominate traditional markets like commodities and equities, often offering regulatory clarity and fixed settlement timelines, but require traders to manage rollover costs and basis risks when maintaining positions beyond expiry. So again, that's where we get into the difference between using them for scalping versus trend exposure, and just the fact that a perpetual you can hold for a period of 5 years. A futures contract, you hold it till the end of the month and then you got to roll it over, and we'll go over later in the video why sometimes that can be a little complicated. If you have any questions about that, feel free to leave it in the comments down below, but otherwise I'm not going to spend a ton of time on what these actually are. It is important to take into account things like your position sizing, how to scale in and out of positions. I'm not going to go a ton into this video, but I will go over that a little bit right here in this section. How do we profit off of these contracts? The best way to do that, my friends, is by increasing our knowledge of this guy. This is the Bitcoin chart. The better you understand the Bitcoin chart, the more that you are going to be able to profit off of your exposure to the trends or scalp trades on the Bitcoin chart. Part of the reason why I discovered this strategy in the first place was because I was trying to apply my knowledge of the Bitcoin chart to correlated assets like IBIT contracts for options or MSTR or any of the miners. That's what I was originally trying to do, is trying to find if there was some correlation between how Bitcoin behaves and how everything downstream of Bitcoin behaves. The beauty of these perpetuals and futures contracts is I don't have to do that anymore. I can just look at this one chart and I can profit off of this one chart. It's the best thing I've ever found. It's very, very common for other traders in traditional markets to take a look at the ES or futures contracts in order to be able to understand how SPY is going to behave, as well as downstream of that, the majors like Google, Apple, Nvidia, etc. They will oftentimes get that information from looking at the indexes. And this is very similar, where we're going to use the Bitcoin chart itself in order to be able to make defined decisions about when we should enter a trend, when we should exit a trend, without having to, like when I was doing this with option contracts and other things that are not directly on Bitcoin, there's too much lag between the information. There's periods of times where it's closed. These contracts are open like 22 hours a day. I think there's or 23 hours a day. I think there's like 1 hour during the week when it's closed. And then I think there's a couple hours on the weekends when it's closed. But functionally speaking, it's about as close to 24 hours as you can get. And it really just comes down to what I mentioned before about position sizing. The most important thing that I'm developing for this strategy is making sure that you have enough margin in the account so that you don't get liquidated during the overnight hours. Now, again, this is a little bit different for people outside of the US or people who are using platforms that are not Coinbase, something that lets you trade isolated. But essentially speaking, if you have $3,000 worth of cash in your account, that means that you can trade $1,000 worth of contracts even when we're in the overnight position. Now, again, that is specifically for the 10x leverage contracts with Coinbase. Obviously, the math is different if you're trading 100x on other platforms, and that is your discretion, my friends. I'm just here to help you with the analysis. I'm here to help you define your entries and exits a little bit better, but a lot of people make more money off of my analysis than I do, but that's what you need. You need to be able to understand the Bitcoin chart very well, and you need to have the stomach to apply risk to that, and you need to make sure that you have your rules carefully defined. Otherwise, it's just as easy to lose money with this strategy as it is to make money with this strategy. So how do we profit off of them? Knowledge. Knowledge is how we profit off of them. The next part is the rules for the 4-hour break room. This is probably the most important thing. This I've started to shift a bit over time. I originally discovered this because I was looking for a repeatable pattern. That's where I came into contact with the 4-hour chart itself, as well as the Bollinger Bands. Really kind of became the clearest example that I can see of a repeatable pattern for entries. And then I have also defined what my exit positions are. And this will be a little bit different for everyone, but I will give you the system that I use. And then we can move forward one rule at a time. What are the rules? Rule number 1, entries are best taken on 4-hour candle breaks to either side of the Bollinger Bands. Jacob, what on earth are you talking about? Let's go over here and take a look. So this again, our overall knowledge of the chart is going to come into play a little bit later, but we want to look at specifically the 4-hour chart now. And we are looking for instances where the candles are outside of the Bollinger Band. So they are outside of either side of the Bollinger Band. When it is outside of the top of the Bollinger Band, that would indicate a short. When it is outside the bottom of the Bollinger Band, that would indicate a long. So that's the most basic part of the strategy. It does get more defined than that because obviously you would not have wanted to long every single one of these. That's where we actually get into the next rule that we'll go over in just a moment for identifying the actual best entries. But that's essentially the broad rule, is that the price will spend more time inside the Bollinger Bands than outside the Bollinger Bands, which means that when the price is outside of the Bollinger Bands, that's giving us more information, a more clear entry position for us to take our trades. This is a little bit more important for the scalps than, I shouldn't say a little bit. This is more important for the scalps than the trend exposure trades. And again, I'll go over that later on in the video. But for all intents and purposes, these are our best and most clearly defined entries. These are the entries that I go over in the 4-hour break room membership. This is the best information that I can give you is when we see candles like this, you want to be paying attention to the chart. That's all that matters, first and foremost. So that's rule number one. You want to make sure that we are outside of either the top Bollinger Band or the bottom Bollinger Band. That's going to influence whether you are longing or shorting the price. Your emotions don't matter, just the chart. That's all that matters. Rule number two. Best entries are kissing candles. I think they're actually called tweezer bottoms, but whatever, that's lame. I call them kissing candles. What is a kissing candle? Dear God, what did I do? So sorry. So a kissing candle is these guys. Is when we have candles that are closing right next to each other that are outside of the Bollinger Bands. So that's what we're looking for. Now those happen roughly every 2 to 3 days. It's not exact. Sometimes it happens extra times, but typically speaking, you won't go more than a couple days before you see one of those very, very clear entries. Now again, some instances are, I think this is a later rule about the actual percentage that we're looking for with the scalps, but this is, again, the clearest definable thing that I could find on the chart is you can't really get a clearer entry than that. You know, like that's just very clear on the chart when you get something that looks like that, where you have both candles, one closes and the next one opens directly next to it. In this particular example, for example, we wicked this high, or actually no, in this example, this is a green candle. So it started down here, it rose all the way up here, it rose as high as this wick and then closed here. The next candle then started here and pushed down, was able to get as high as back here before then continuing to drop and closed here. So we want candles where it doesn't really matter, as obviously it's inverse for if we're looking for a long, then we want a long red candle followed by a green candle, and the inverse for if we're looking for a short, we want a long green candle followed by a red candle. But as you can see, there are some instances where the actual body of the candle doesn't really matter. It's more, for me, I'm looking at, are they kissing or not? Are they right next to each other? Are they outside of the Bollinger Band? Because that has a much higher probability for a trade entry than anything else I can find on the chart across all time frames. This does not work on other time frames as well. I've looked at the hourly, I've looked at the daily, the weekly, etc. You would have way less setups. This is the most repeatable setup that I have found, is looking specifically at the 4-hour chart. This is what a lot of professional institutional traders use. They use the 4-hour chart. And again, that's what we're looking for. We're looking for two candles that are right next to each other. And it'll feel a little bit different as the candle is actually opening. Because for example, with this guy, you would see candle opens here and starts going, but initially it did spike up. So you want to look for confirmation on the second candle, not the first candle. And again, this is why I run a membership around it, because sometimes it's not obvious. Sometimes we are in regimes where it just continues to drop, and that's where it really comes into play. If you have to know whether you are doing a scalp trade or whether you are just holding on to trend exposure. And we'll go over that later on in the video, but it's really, really important that you know the difference of what trade you're actually in. Super, super important. You don't want to mess that up. So, rule number 3, don't overcomplicate exits with too many indicators. So I've already kind of gone over, whoops, didn't mean to do that. I've already kind of gone over the entry positions. Like that's when you take an entry. You take an entry based on the 4-hour break of the Bollinger Band. That's when you want to take your entries, specifically for scalps. So you can be a little bit less specific about that for long trend exposure. But when we're looking for scalps, that's what we want for an entry position. It's just the kissing candles outside of the bands. So what do we want for exits? Well, for exits, I don't like to complicate things. I like to make it very, very simple. Again, this depends on whether you are doing a trend exposure trade or a scalp trade. How I discovered this strategy was specifically for a scalp trade, and I don't use many indicators. This is a free version of TradingView that I'm using. I'm using 2 indicators. I'm using the Bollinger Bands 20-week SMA. Now you can use a different time period. You can use a 50 or 100 or a 200. I don't care. I like the 20-week. It works very well for me. Anyone who's following this channel, you know I'm able to be highly accurate about the price while using the 20-week SMA, standard deviation of 2. You can pick whatever colors you want, doesn't really matter. I didn't touch the visibility, so that's all you need for that. Then what I use for my exits and just in general for understanding some of my other key levels is, this is called Pivot Standard, I believe. And what I changed was I set it to Fibonacci, I set it to auto, I set it to 5 pivots back, and then I don't think I touched anything else. Pivots standard, something like that. Pivots points standard, that's what it is. So that's what I use for understanding, basically, when I'm looking for an exit, because again, I believe that this is the next rule, but what I found from back testing this strategy deep into last year, I sat down for like 10 hours one day and just went back like as far into the chart as I possibly could. What we're looking for, and the reason why we like these candles so much, is because in most instances, the price will go at least 1% in the opposite direction. Now that's more than 1%, that's about 2%. So for me, what I found to be about 70 to 90% likely is that the price will go at least 1% before it then does something else. So we don't necessarily know when it's going to do something else. And again, there's going to be instances where you could long that technically, but you would not have very long before you have to get out of it, or you'd have to be patient. Because again, there are plenty of instances where you enter a trend early and you just got to wait. You got to wait a little bit of loss. You can even add to the position if you would like to. And I can go over that example a little bit later about how anyone who follows this channel already knows, I was wrong about a trade for about a month and I was still able to close it in profit just by waiting. That really comes down to opportunity cost. You either are someone who you want to be taking all of these setups, or you are comfortable with just kind of taking the ones that are the most obvious. So what we're looking for exits is, I think of it in a couple different ways. I think about it as, you want to have a generic take profit 1 for scalps, which I would just define as 1%, because the highest probability is for a 1% move. Say you buy 10 contracts, you want to close 3 to 4 of those contracts once you hit your 1% mark, assuming again that you are scalping instead of trend exposure. For example, the recent trend exposure trade that I took a short here. I'm breaking my own rules in doing that, but I knew based on my historical analysis, and again, anyone who follows this channel knows I talk about the same levels all the time. I knew when we retested 76.3K in a position of weakness that was going to indicate further downside momentum, which again is why it's very important for you not to ignore the higher time frames when you are taking these shorter term trades. It does not exist in a vacuum. You have to be able to have both things in mind. So that's what I like for a take profit 1. When I'm looking for a take profit 2, I'm typically looking for either an interaction with a Fibonacci pivot, because as you can see, like this guy, for example, we got up there, tested back down to it, and then continued on. But we could have just as easily shown weakness at that Fibonacci pivot, in which case it may have been a good idea to close it. For example, like this guy. So this isn't quite as clean as an entry. This actually is the cleaner entry. So we had strength off of this Fibonacci pivot, no reason to close the trade, even an argument to add to it in that case. Then we had weakness at this Fibonacci pivot, which technically would be an indication of a time to close more of the positions. And then this one got to the SMA. And again, we're looking at either, so our Bollinger Bands gives us our entry positions based on the Bollinger Bands itself, but it also gives us the SMA. We do not want to take entries based on the SMA because it can flip in either direction. It's highly unpredictable, whereas the Bollinger Bands are more predictable. But we can use the SMA as an exit target as well. It's not always guaranteed to break to the other side of the SMA. Many times it will fail the SMA. So I just use that as a take profit 2, either a Fibonacci pivot or the SMA, depending on which comes first. Sometimes we're not that close to the SMA or not that close to a Fibonacci pivot. So I kind of use them interchangeably, but that's what I'm using as more evidence, again, of a scalp trade. And then the only other difference I would say that you really need to pay attention to is this guy here. So if you start at the bottom of the Bollinger Band and it's able to break through the Fibonacci pivots as well as the SMA all the way to the other band. So again, this is indicating a short, this is indicating a long. So if you're getting all the way to the opposite end of the Bollinger Bands, you really want to close that trade if it's a scalp, because otherwise you're now going to be in a position where you may be able to stay in profit, but the maximum profits have probably already been reached. This is not unilateral. There are times where it's not the case, but there are just way more instances where it is the case, where it makes sense to get out of a long trade once you hit the top band on the other side. And the same to the converse, where had you taken this, you're short, it would have been, I guess actually in that instance, you could have stayed in it. So that's the thing, is you got to be able to understand the difference between long-term trend exposure and scalps. Scalps you're going to be in for a shorter period of time, a day or a period of a few days, but that is something you want to keep in mind, is you don't want to stay in a position for a long time once you've already tapped the other Bollinger Band. Super, super important. And again, we're looking mostly for 1% swings. So that is, don't overcomplicate it with too many indicators. I'm using 2 indicators. That's it. I have a tool that I use as well called the Anchored VWAP. You can go to the courses tab in the YouTube where I explain the Anchored VWAP more. And let me know in the comments if you want another video about that. Okay, rule number 4, probability is highest for 1% reversal scalp. So I already went over this a little bit, but let's really take a deeper look just to understand what I mean. So in this most recent one, for example, again, we don't want these guys. These are not kissing candles. They're not kissing candles. This is a kissing candle. So in this particular instance, we have a very shallow green candle there, but technically it's still moved above 1% for that wick. So even in an instance where it's not really the greatest trade, it will still, in a lot of cases, provide a 1% scalp. I found it to be true in, like I said, about 70 to 90% of cases where we have specifically the kissing candles. Not random candles that are closing at one side and then the other, but specifically with these kissing candles, it is very common for the price to move 1% or more. Again, the probability is highest for 1%. And if we think about it in terms of position sizing, if you have $1,000 that you're trading with, that means you have $3,000 worth of cash in your account total. If your $1,000 is exposed to 1% move at 10x leverage, that means that you just made $100. That's pretty great. You know, that's a lot of people's jobs. They only make 100 or 200 bucks a day. So only risking $1,000 in order to do that is a pretty great deal, to be honest with you. And obviously that number goes up by quite a bit. If you're risking $10,000 at that time, the price moves 1%. You just made $1,000. And again, this candle in particular, it moved 2%. It did not move 1%. So there are plenty of opportunities where you're going to catch more than a 1% swing. But if you hit a 1% swing every couple days and you have a sufficient enough capital in your account, you're going to be fine, my friends. You're going to be just fine if you're stacking multiple 10% wins. This is also a big reason why I don't really care what altcoins are doing. The other day I was talking to a friend and I told him I had made 150% on a trade, and his first question was, what do I think of this EV stock? Like, I don't think it makes sense to people that you really can just look at one chart and never have to look at another chart again. Once you learn how to fish on the Bitcoin chart, you don't need to look at other charts. This is why I have made a channel about it. It's like I want people to understand that. You don't need to overcomplicate it. If you want to hold other things, that's fine, but Bitcoin is probably a better store of value than those other things. And if you can get way better at understanding what Bitcoin can do, you're going to be able to profit with these perpetuals and futures contracts essentially to the same degree that you are able to profit with anything else. From this entry over here that I took, I am now up, I think, like 160% in a period of less than 2 weeks. I haven't had to do anything. I've done nothing during that time period other than just watch the chart play out the way that I expected it to. Again, that's the difference between a trend exposure trade and a scalp trade. But functionally speaking, how I found the strategy and what interested me in the strategy so much is when we combine our kissing candles outside of the Bollinger Bands with just an understanding that that is indication of a reversal trade, paying attention to our key exits within, again, I'm using 2 indicators. I'm not using a million different indicators. You do not need to make this that complicated. There is a high degree of probability where you're going to get a reversal trade off of those types of kissing candles. So that's what we're looking for, again, first and foremost for the scalp trades versus the trend exposure trades. it's like the trend exposure trades are easier, considerably easier, quite frankly. Again, to be up by 160% and I haven't done anything, I've made way more money off of that trade than I would have by continuously hopping in and out of these other scalps. But it is worth noting that they both have a place in your portfolio. I think over time, I'm really starting to appreciate just the perps and the trend exposure more than the scalp trades. But because I discovered this strategy and have built this strategy around the scalp trades, I don't think it's worth completely ignoring them. I think you really got to be able to balance too. So again, probability is highest for a 1% reversal when we have a break either to the top or the bottom band of the Bollinger Band. And then you need to pay attention to your exit criteria. Again, that's going to be your 2 indicators, as well as just an arbitrary 1%, 2%, etc. It does seem like 2% is the next highest probability. I don't know exactly what that math is. I would imagine between a 40 and 65% probability that it'll go 2%, but the higher probability, again, is for a 1% reversal. Rule number 5. Perps are for trend exposure, futures are for scalps. So what do I mean by that? What I mean is I broke my own rule when I entered over here. This is a long period. However, that long is only about a 24% trade, which is great. That's great. I would much rather take the 160% trade. So the reason why I was able to do that, this is the middle of May. I already knew we were on a downtrend from May. This is where you really need to be able to combine your historical and technical analysis on the higher time frames with what's happening on the lower time frames. So right around that time period, that would have been this guy here, we had another interaction with the weekly SMA. So at this time, I was watching other channels talk about how Bitcoin was about to snap back to 100K and laughing, because that makes no sense based on the chart. It's ridiculous based on the chart, you know, based on, and this is not necessarily for the trading criteria, because again, we like to use the 4-hour break room, the 4-hour time frame, even though we can get our information from the higher time frames. But when we had a break of this key Fibonacci pivot point that we've been, anyone on the channel knows about 76.3K. I never shut up about 76.3K. We've been stuck there since February. That was super important for the price to behave in a predictable way at that time, either to break below it or to show strength above it. When we had another interaction with the weekly SMA again, I know from my historical analysis that we only have one instance on the chart where we spent more time above on the weekly time frame, specifically in a bear market year. Obviously, there's plenty of instances where we spend long periods of time above it, but we want to go based on the actual year that we are in for the cycle, which at the moment is a bear market year. So this is really where it comes into play for, if you're going to have trend exposure, you've got to know your history. So there are some people who, you know, like one of the channels that I follow, who he has way more money than I do, he's considerably more successful than I do. His bias during that time period was that the stock market is ripping, real estate is ripping, so Bitcoin must follow. And that is delusional. That's not how it actually works. Bitcoin is designed to be a very specific mechanism within the existing financial structure. I am not someone who thinks that Bitcoin is designed to replace it. I think Bitcoin was designed to fit snugly within it, which means that when everything else rips, it's easy to continue devaluing Bitcoin. And then once everything else has topped, where does that money go? It goes into Bitcoin at its local bottom. That's why I believe for the rest of 2026, we will continue to see downside momentum. Nobody knows exactly how low. If you want to know what I think about that, again, follow this channel and I will continue to give daily analysis, or semi-daily, Sunday, Monday, Wednesday, and Fridays at the moment. But that's what we're looking for. We're looking to confirm our higher time frame analysis with a trend exposure. So I knew once we had more instances of hitting the weekly SMA again after breaking back above it, I knew that I needed to be exposed to the downside, period. Now, did I predict that it was going to be as significant as a move as it was? No. And the beauty of it is I didn't have to. I didn't have to know exactly what it was going to do. I knew that at a key Fibonacci pivot level, that it would behave one of two ways. It would either close that week above it or below it. It closed that week weekly. So I think I had like 2 or 3 days where I was in a little bit of loss during that, but I was not concerned. I was more focused on paying attention to our support and resistance levels. During that part of the range, we had failed at 78 after breaking down to 63. And essentially we just saw tightening of this range that I knew was going to break to the downside, and I wanted exposure to that. So I could have chased my scalps during that time, but there are times where your perpetual trades in particular, you want to be exposed to the longer trend. So again, I'll give an example that everyone on the channel would have already known about. I have been talking about, let me get this guy out of here. I've been talking about this rise to 83K since all the way over here in February and March. I've been saying that every week. You know, I believed we were going to make a run towards 83 to 86K. So what that means is I wanted to be in long exposure, and unfortunately I didn't find these, I think, until March. Otherwise I would have been doing it from the bottom there. But functionally speaking, had you caught this at the bottom over here, which would you look at that, the exact bottom was our criteria. It is those kissing candles, you know, that would have been the best time to enter that trend. It would have been consolidation for a long period of time, but that would have been the best place for you to kind of build a foothold for your perpetual position. So again, you can hold a perpetual position for 5 years. Now, is it time to do the turbo long yet? It is not. And again, that's what we're going to talk about at the very end of this video. That will be life-changing for you, myself, and anyone else who watches this. But that's what we're looking for trend exposure. So we want to pay close attention to how the price is behaving. Now, I knew it was going to do that again because of the higher time frame historical analysis. But what that meant in that instance was we found the local bottom. We don't know if we're going to go higher or lower, but it made sense in that instance to have upside trend exposure. Now, that didn't mean that you couldn't take, like, this is a great example, for example. When we rose from that range, we rose all the way up here to 74K from 60K, which is a great trade. No reason necessarily to keep that trade open. However, if you wanted to continue to compound that trade, to let that trade run, because there were other instances where it would have made sense to add to that trade instead of closing to it. So I really like having perpetuals just to maintain trend exposure. You can only do this if you understand how the price is going to behave historically. I don't know why more people don't factor this in. You know, like, it really is as simple as understanding the higher time frame chart. If you understand there are differences every cycle, but it is closer in similarities than it is different in differences. You know, like, it has a lot more in common each cycle than people like to admit. So in that particular example, it would have made sense to have long exposure during that time. And if you wanted to take exposure to the downside on any of these other movements, for example, this guy right here, that's a pretty nice scalp, being able to take 10 to 11% on top of maintaining your long-term exposure, you know. So it really, in order to do trend exposure properly, and quite frankly, there would be nothing wrong with you taking a long here and then flipping short and then taking another long here at another time. And sometimes that is the argument, you know, like when I forget the exact, I guess it would have been over here in March, I shorted this initially and was correct. I would have been correct. However, I panicked because I thought that we were going to get that move to 83K all at once, and I was wrong. Period. I was wrong. So I held that long because I knew we were still going that direction, even though we were not there yet. I had high conviction that we were still heading that direction, and I would rather save the money than lose the money, which just functionally meant that I missed out on about 8 to 10 setups for scalp trades. Not the end of the world, but again, I broke my own rule in this instance. That was a short, not a long, period. It's not always going to be super, super obvious which one it is, and even if you are very good at analysis, you're going to make mistakes. Again, it involves risk. There, you will have losses, but I've lost a lot of money with options contracts. I've lost a lot of money with memes and altcoins and forgetting wallets on Web3 and such. It is, even in an instance where I was objectively wrong with this trade, I was still able to close that trade like 14% in profit, 140% in profit. So there's no excuse for ignoring this strategy. And that's how you would like to use it. Again, is you have part of your portfolio, which is just trend exposure, which is, I believe that the price is going to go up over X amount of time period. I want to catch as much of that move as possible. For me, I focus again more on the key levels, as opposed to, the more I try and get like specific time frames or whatever, like it must be by this week in March or May or whatever, the more you get shaken out. But when you focus on key levels, which are a combination of, I like using the Anchored VWAP tool as a free tool here on TradingView. It is the best. I forget where it is. I think it's in forecasting. Forecasting tools and measure. Yep, Anchored VWAP. That's what you want to use. That's what creates these bands. I go over this all the time. These function as kind of magnets for the price. And I was able to call out 83 because we have the anchored volume profile over here, which is also in the same segment. That was showing me that we have a thinness in terms of the actual amount of buyers and sellers behind that button at the time. So basically less people with strong emotions around those prices. And that's how I was able to anticipate that way ahead of time, like months ahead of time. I called this out in February. Again, anyone in the channel knows I've been saying the same thing for months. So that's how we kind of have we use the higher time frames. We use the Anchored VWAP tool to give us kind of a clear understanding of what direction do I believe the price is going to go in the short term. And that's what we want to have our perpetuals tied to, is as much exposure to that trend as possible. That's how we get these big, big gains. I didn't even catch this short from up here. I was more focused on other things at the time. I again caught it over here, not even at the best time. And I'm still up, 140, 160% on this trade at the moment. I'm actually at the point where I'm having to consider whether or not I want to close this trade. But functionally speaking, that's the difference between long-term trend exposure, which is we just want to catch as much as the broader swing as possible. So those trades will typically take weeks or months. For example, I believe that this trend is probably going to change by the middle of June. So we have the FOMC, as I'm recording this, we have the FOMC meeting on the 16th of June, which is a couple days away, about 2 weeks away. Obviously that's not relevant to you if you're watching this considerably later, but that's kind of what we're looking for. Is I want to look for key news pivots or key events that are similar to other times on the charts, which is how I've been able to do this. It's how I've been able to call out significant ranges in the past, is what did it do in the previous cycles. Now, obviously, as I'm recording this, we're in a bear market year, but it will work in a similar year, in a similar fashion for the pre-halving year, as well as the halving year and into the post-halving year. So you really want to pay close attention to which part of the cycle we're actually in before you just make blanket statements about that. But that is how I'm able to predict it so accurately. So again, in this particular example, this will not be useful to you if you're watching the video way later, but I believe we will find our local bottom fairly soon in June, and then the trend will reverse and we'll start to see a lower high form in July before the full capitulation. So at this moment in time, I'm having to decide between, do I want to close my short and expose myself with perpetuals to that again, higher low is what I'm anticipating in July, not a higher high. So it would be a failure at that time that continues low, which means that I believe the price is going to continue to go lower after that point, even though it's going to go higher. So that could be an instance like this, where I believe that the price is going to go lower after this initial time, even though initially it's going to go higher. So we may actually want our short to be from up here, not from up here, because we'll have to have a significant period of time in pain. And that's where it comes into play of you're either focused on your scalp trades or your perpetual trades. So in this particular instance, if I didn't want to close my short trade, and instead I want to compound my short trade when we reach those lower highs in July that I believe, then the best way for me to profit off of this uptrend is going to be taking scalps with my futures contracts. So that's why we kind of have to use both in tandem with each other. If you have any questions about this, please leave it down below. I know this is a little bit complicated, but that's essentially what we want to do. Is we want to have perps to have our long-term exposure to whatever the trend is. We're going to identify our long-term exposure by understanding the historical analysis of the chart. If you need help with that, that is what this channel is for. That's why I release videos all the time. That's why I release the newsletter every Monday at bitcoinescapeplan.com. Make sure you are subscribed. I'm doing as much as I possibly can to help you understand how the price behaves. The rest of it, you're going to have to do on your own. So that's what we're looking for specifically, again, for the difference between long-term trend exposure and scalps. Scalps are going to be quicker opportunities, or just when we don't want to close our overall bias. It's going to be a tool for us to allow continued exposure to whatever the actual trend is while still profiting off of the other side of the trade without having to close our trend exposure. Super, super important. And I will continue to update how I feel about that over time because I've continued to change my opinion about it, but super, super important. Do not ignore the higher time frame analysis. So this is very, very important, and it will bring us into the end of the video. This is a lot of what I just went over actually, where again, you want to take a look at the higher time frames. That's how I was able to isolate that 76.3K was going to be a significant point of resistance if we showed weakness there. That's how I was able to identify my long-term trend exposure as opposed to paying attention to the scalps. And I actually knew to stay away from scalps during that time because of the change on the higher time frame. And again, the best that I can do for you for that is watch my other YouTube videos. That's the best I can do to make sure that you are ahead of the curve on that. So if we go back, we have gone over what perpetuals and futures are. We have gone over how you can profit off of them by increasing your understanding of the Bitcoin chart and using this channel here to help you do so. We have gone over our rules for the 4-hour break room, which again, you can request access to down below or book a one-on-one call with me in the Calendly in the link in the description. We have gone over the difference between scalping versus trend exposure in its most simple form. And now we want to get into the big picture cycle application. This is the moment you have been waiting for, my friends. This is where the actual crazy money comes into play, and it's not something that you want to ignore. I don't care if you watch this video a bunch of different times between now and the end of the year. You need to make sure that you understand this video before the end of the year. It's very, very important. Let's go take a look at what I am talking about. So, when we talk about long-term trend exposure, so BitMEX has been doing this since 2016. So all the way over here, you could have technically taken a long or a short during that time period. I do not live outside of the United States, so I cannot use BitMEX or BitUnix or a bunch of other ones. But functionally speaking, what these are actually created for, what the President of the United States and every other rich person that you follow on CNBC or whatever, what they are going to do is at local bottoms like this, you have one of two options. And really, intelligent people do both. And this is what I will be doing at the end of the year. I will have a certain amount of cash that I will be using to buy spot Bitcoin. Now, if you want to understand a strategy that I have to increase the amount of cash that you have available to you by using your credit balance transfer offers in order to maximize your earning potential and investing potential with Bitcoin, I do have a course on that directly on the website. It's also in the courses playlist here. You do not want to miss that. I wrote a whole book about it. Go check it out. It's again, I have never heard anyone else describe this strategy, but it is crucial for using your credit score in a way that's going to help you maximize your opportunities here. I'll also leave that down in the description below. You don't want to miss that one. It has been life-changing for me. It has allowed me to take income where I was below the poverty level and still get almost a 6-figure amount of capital in a very short period of time. You do not want to sleep on that. Very, very important. So the two things again are you want to be able to maximize your actual spot Bitcoin exposure at the time of the local bottom, wherever that is. My money is on somewhere between 34 to 39K, but I don't really care if it's just 50. That's also fine with me. Just so that you can get as much Bitcoin as possible at a great price. Quick sidebar on that. Anytime we're below the weekly or the monthly SMA is a good time to buy Bitcoin. People ask that all the time. When is the best time to buy Bitcoin? Best time to buy Bitcoin is when we are below the weekly or the monthly SMA, period. When you zoom out far enough on the chart, those are the time periods where you had to sit in periods of loss for a short period of time, and then you're in profit essentially forever. And that is how we want to think about it. So, again, the only other part of this strategy is maintaining maximum exposure with your leveraged contracts at that point as well. So you want to be able to buy as much Bitcoin, but you also want to be able to have as much money as you possibly can in your Coinbase, BitMEX, BitUnix, wherever, so that a lot of it can sit in margin and that the rest of it can sit, and actually be able to be deployed. So in this particular example, I'll go over what I think is going to happen this coming year, or years rather, plural. And this could be very different. I'm not going to tell you exactly what the price is going to be in 2031 because nobody really knows. What I will tell you is that they are formalizing around the strategic Bitcoin reserve. They're really trying to plan for a 5-year time period. Why are they trading for a 5-year time period? Because that's how long perpetual contracts last. So what I would imagine is going to happen is that at whatever the local bottom is, the people who are market makers are going to know that it's the absolute bottom. At that time, they will maximize their exposure to the Bitcoin perpetuals to the upside, and then they will do nothing at all but pay taxes at the end of the year. That's it. And that's how you can get exposure to crazy returns. Like this is an 8x, I believe. That would be an 8,000% return on your money at that time. So the example that I'm using for this next coming cycle, I believe that we will probably, like I said, break below 50K. But let's say that 50K is the lowest that we're going to go this cycle. If you were to buy $10,000 worth of these option contracts, which means you have $30,000 total worth of cash in the account, so you can sit through the overnight positions. Because again, during overnight, you can only trade 3.3x leverage. Again, this does not apply if you're doing offshore exchange, but I'm going primarily off of the Nano BTC Coinbase perpetuals and futures. So you need to have enough cash in the account so you can sit through the overnight. Obviously, you're going to have a lot of overnight sessions over the period of time of 3 years. But I'm focusing on that primarily because I believe the peak in 2029 will be somewhere around the range of $200,000 to $250,000, potentially much higher. What that means is that $10,000 will become equivalent to $400,000. You heard that correctly. $10,000 worth of exposure at the absolute bottom at 50K on its rise towards 200K will be about $400,000. Now, obviously, again, you'll have to pay taxes on that at the end of the year. On December 31st every year, they will basically treat it as if you've already taken your profits. I think that's why sometimes it will drop right after that. Is because if people didn't already take advantage of some of the profits, they're going to miss out on it. Like it could actually go against them and they're still liable for the taxes either way. So that is an important thing to pay attention to. You really want to make sure that you are willing to take some cash out in order to be able to pay your taxes. So you wouldn't, in this particular example, again, of it going from 50 to 200K, you wouldn't actually get the full 400,000. I mean, one, because you got to pay taxes on it, but two, you're probably going to have to close a little bit of it on the way up. But the idea is maximize as much exposure as you possibly can at the bottom. Either use other cash to, which that would be the best case, is if you have a job or if you're using the futures and scalpings or something else to generate income in order to pay the taxes off of it. That would be your maximum ability to maximize your exposure, is by not having to actually trade any of the contracts. And that would be the perfect scenario, is if you can literally wait a period of 3 years from the bottom to the absolute top. You would be very happy. You wouldn't have to do anything else with your time. I'm very much looking forward to this at the end of the year, having as much exposure as I possibly can, both increasing my actual Bitcoin stack and increasing my exposure with leverage at that time. Now, there are going to be a lot of people who are saying how risky that is, who are saying, oh, you should be using a stop loss or whatever. I understand what they're saying, but Bitcoin behaves in a fairly predictable way. In 2022, I was able to write down on a piece of paper by using a calculator that I believed that we would get to somewhere between $130,000 and $180,000 as our conservative target, or between 210 and 240 as our impressive target. We got to 126. That's very close to 130,000. And again, I wrote that down on a piece of paper in 2022 using a calculator. I did not even understand. I wasn't even using Bollinger Bands then. I wasn't using Pivots, Fibonacci, Auto. Like, this was way earlier in my understanding. All I understood was the cycle theory. All I understood was how it behaves over a 4-year time period. And that's really what you want to be able to apply, is how does it behave over a 4-year time period? How it typically behaves is it will head down to a local bottom during the bear market year, that is this year, 2026, and then it will continue to rise in the opposite direction for a period of about 3 years before it tops. So again, in that particular example, what I'll be looking to do is close that perpetual trade at that time. I will then take all of that cash and I can do whatever I want with it, which I will probably use it to buy more Bitcoin at the local bottom. So the question of how much Bitcoin do you need, you will never have enough. That's the point. But if you're wondering why Michael Saylor has built a business around it, it's because you will never have enough. That is the point. So that's the broad idea for the big picture cycle application, is you want to make sure that by the end of this year, 2026, that you understand how to trade perpetuals and futures sufficient to the amount that you are able to set your longs at the end of the year and then do nothing. The same way where people who are already in the know, and God, I wish I had known about this already, could have shorted the 126 all-time high in October of 2025 and would be doing nothing right now other than letting that short continue to run until we find the local bottom, which again, I believe is probably somewhere between 34 and 39K. That's it for this video. If you would like to check out the next video, the most logical one again is going to be that how to leverage your credit in order to increase your exposure during periods of the most important times in the cycle. That's what I do in that video, is I help you understand that more. Check out the website, buy a book, book a one-on-one call, all of that in the link down below in the description. Have a wonderful day, everyone. Thank you so much.